Now we get to talk about OPEC. Now, clearly, I missed a lot of things when we look at OPEC and the craziness that ensued. And I was actually in country when a lot of, I should say, in the Middle East and in the UAE when a lot of these things were happening. So you can guess at how this was a hot topic in terms of discussions. Now, but while we were setting up for what's going on right now, we did see a new article that came out talking about U.S. travel growth projections and what those expectations are post-pandemic demand, how that shifts. So when we look at domestic leisure travel is slowing, and you had that post-pandemic spike, and now you're starting to see again that come down. Now you are getting an increase in business travel, but that's being waylaid by, again, that slowdown in other travel. And based on the math for what we're seeing so far from people, it's going to be difficult to see us make up those year-over-year increases when you look at core traveling season, which is in the summer. So now when we look at the IEA, they cut oil supply expectations for the Americas and OPEC 13. When you look at it, in general, world supply, they took it down further. But you're still seeing the balances are fairly, normal, or I should say fairly kind of 100,000 barrels down. US EIA took things, took those balances, now moving into deficit, where before the EIA was really the only one that saw a slight build. A lot of that is just that shift because of OPEC, because of what has been done in general. So let's just go through what happened. So what did we hear? So Saudi July production did drop to 9 million barrels a day. So again, that's the 1 million coming from Saudi. So they were just over 10 million. We have the numbers. We'll show you what they were. Just around 10 million. So essentially going from 10 to 9. OPEC now extended cuts into 2024, not at the same level. So right now in 2023, it's supposed to be I think it was 3.36. I have the numbers in another segment, but another slide, but I'll look at that. And then it's going to about 1.3 million in 2024. Still down, but it's important to understand what that reduction is, because the reduction is more of a reflection of a drop in production versus quota. So even though 2024 looks lower in comparison versus that makeup between quota and production, it really isn't. It's just kind of bridging that gap. And it'll be interesting to see because, and we'll talk about this in tomorrow's Econ show, the IMF, the World Bank took some of their GDP expectations higher in 23, but lower in 24. And that's, I think, something that is not being captured right now in some of the expectations, where everyone's like, oh, demand is going to soar, things are going to make sense. It's like, whoa, let's look at industrial activity. Let's look at where things are. Let's look at the impacts of stagflation. And we see, again, that kind of perpetual slowdown and those problems that we really don't see going away. Now, Saudi will make a deeper cut to its output in July on top of what was done, again, going to about 9 million. But this is my favorite quote because, again, it's a conundrum in its own right. This is a Saudi lollipop. Saudi Energy Minister Prince Abdulaziz told a press conference, "We wanted to ice the cake. We also want to add suspense. We don't want people to try to predict what we do. This market needs stabilization." It's like, okay, so you're adding suspense and you don't want people to predict what you're going to do, but you need stabilization. So if you're unpredictable and adding suspense, how does that create stabilization? And again, like if you wanted to say that, we're looking to maintain the supply level, just assume that if the supply level goes too low, we'll increase it. If it goes too high, we'll pull it. Like that's creating stabilization. Those comments, for anybody that's watched a suspense movie, a horror movie, you jump out of your seat because you're in suspense. So adding suspense means that people are going to jump out of their seats when something happens, which they don't want. Again, like the first two pieces match. We always want to add suspense. We don't want people to predict what we do. Those fit. That makes sense. But then this market needs stabilization. Again, very counterintuitive when we think about stabilization, or at least my understanding of stabilization. But if you put it in the context of 75 Brent is their goal or target, then you kind of see it's like, well, how much suspense could there be? So now when you look at April into May, here you can see that there was a drop of 464,000 barrels a day. And that was driven by the UAE and Saudi Arabia, as Nigeria saw that increase. We did get Angola, as we talked about. But remember, Nigeria had some force majeures. They had some activity coming back. Iraq is still debating with Turkey on the CN pipeline. So those flows are still not there. So technically, based on the agreement, you could still see an increase from Iraq if they're able to do the deal they're supposed to meet. I believe the most recent headlines were June 19th. So again, Monday, as the Turkey delegation is supposed to land this weekend and start some of those deliberations. So OPEC has in place cuts for 3.66 million barrels a day, amounting to, including the 2 million barrel per day agreed last year, and the voluntary cuts of 1.66 agreed in April. So again, starting to see that, but those cuts were valid until the end of 23. And on Sunday, again, the OPEC deal and a broader deal on the output policy agreed after 7 hours, said they would extend them until the end of 24. But again, what does that mean? But while all of this is happening, you're seeing some different shifts. Now, let's look at the underlying OSPs. So here you have Saudi raising OSPs for everyone. Now the US went from a stupid price to an even more foolish price. So again, the US is going to buy as little as possible because those numbers don't make sense. Mediterranean, Europe, still very elevated. You're going to buy Libya, you're going to buy US, you're going to buy Nigeria, Angola. You're going to buy everything except Saudi. And then to Asia, still second highest they've ever been to Asia, which again is going to incentivize them, buy Russia, buy Iran, buy US, buy West Africa, and leave behind some of these pieces, which to a small extent could be their goal. And the reason why it could be their goal is because they need to preserve a certain amount of volume for themselves, because they did bring on some additional refining and they've cut production. So do they want to draw from storage? Do they want to keep storage flat? Because if Europe maintains their nominations, not saying they will have to pull from storage to make up for it, because Asia's already reducing their value. So again, that was the goal based on these OSPs. But now if Europe doesn't drop, they likely will, then they'd have to draw. So those are the key things to watch. But not everybody did the same thing. So now when you look at Iraq kept everything flat into the US, because again, that's going to keep volumes moving. Increased slightly into Asia, increased slightly into Europe, and then Kuwait, I mean, when you look at US, still elevated, but looking into Asia, not the same level. So you're starting to see some of these key pivots when you look at, Kuwait is much closer to Saudi pricing, but Iraq is still priced to move volumes. Those are going to stay contiguous. But look at UAE. Now, this is interesting because the UAE is still struck at a specific price, and the key is Murban. So when you look at Murban and you look at UAE flows, you're going to see some a little bit more buying from the UAE, and that's again by design, because they have a free floating to a degree exchange, and you're going to see some of those movements, and that's going to be good for the UAE, which is why when they came to this agreement, they actually got their quotas increased. And for those that remember when I talked about this in 2020, 2021, when there was that back and forth and those battles between the UAE and Saudi, the UAE wants their quotas to go up. They have spent billions of dollars increasing production and increasing their ability to produce, and they want that accounted for. So now, even though you still have a cut in 24, UAE is getting a bigger piece of the pie. And that's an important piece because, and this is one of the reasons why we didn't think Saudi was going to push for a cut yet, was because they were going to have to use this political capital. The UAE was always going to get it, but the UAE said that they weren't going to go for cuts until the end of October. They wanted to see the summer. So the fact that they pulled it forward, I think was they were able to get something decent in exchange, which was those increase in quotas. Now, I know that there is a pervasive view that, their supply is dwindling exponentially. We're going to be in this huge deficit. We're not. There is more than enough crude out there to fill the void of whatever's lost. The problem is it has a lot of H2S, sulfur. It has a lot of ancillary problems, so it's more expensive. So that's a long way of saying that prices can still go up, but we don't have to have this big supply drop off. And I think that's the balancing act that we have to look at, where because the Middle East has been spending a lot of money for several years now to increase quotas, increase capacity. And I think that is a good thing, or at least something to consider when you're looking at supply-demand economics. So now when we look at Middle East Arab light crude, Saudi to Asia, giving you an idea, going back to 2011, highest prices since 2022 on an OSP level, again, keeping things very much lower. But then when you look at, I laugh when I look at this. This is Middle East Arab medium into US, hard pass in terms of pricing. Then you look at Middle East into Northwest Europe, it's below 22, but still very elevated versus the historics, keeping things a bit lower. But then when you pick up Murban, you can see that there's still that competition, which is why you could still see people buying UAE even as they don't buy others at this point in time to keep these flows coming. So again, the UAE is playing this quite well when you look at pricing versus volumes. And that's, I think, a benefit that is only going to continue as we progress through the remainder of not only this year, but well into next year as they get that quota jump. Now, here's the important piece that we wanted to talk about, and again, kind of summarize in general. So when you look at the existing OPEC plus cuts of 3.66 million barrels per day, the group also agreed on Sunday to reduce, or the deal to reduce overall production targets from January 2024 by a further 1.4 million barrels a day versus the current targets to a combined of 40.46 million. So again, some of that goes away, but again, you're still seeing that elevated but many of these reductions will not be real, as the group lowered the targets for Russia, Nigeria, and Angola to bring them in line with actual current production levels. And that's what I was saying, where you're just normalizing. So you're not getting a real shift in production. And then the UAE was allowed to raise output targets by around 200,000 barrels a day to 3.22. I don't think they're done getting quota bumps. And I think that was what the backroom deal was for, is let's not shock the market and give us 1 million barrels a day additional, but let's slowly creep that quota higher, and I'll agree to these cuts in 24. And I think that's kind of the back and forth. And it's important to look at output quota versus actual, because you get an idea of that level of collapse and bringing that in line in terms of where they should be. And that's where, why we're a bit more cautious on, what those actual benefits are going into 24, because again, the issue is actuals versus production versus exports, and exports have been very strong, especially from Russia, which is why we still have so much crude on the water. So then when you start looking at Middle East floating storage, you can see that we're still elevated based on where we should be this time of year. Now, it's still below 22 levels, but you see that flatlining, and now we do expect to see a bit of a creep higher. It won't be 16, 17 levels, but you're still going to get that walk up because you're going to get those stranded barrels. Now, this is something that Kuwait may want because they have their refiner turning on. But remember, if they're not exporting crude, but they're exporting more product, did the market really change? And the thing is, and again, is it doesn't have to be one for one, but it's important to look at is if crude export, let's just use round numbers. So say crude exports drop by 1 million barrels a day, which means that Europe, US buys less. But then the Middle East increases production exports of product by 1 million barrels a day. Well, did the market shift in a meaningful way? It's just they replaced one product with another, but one for one. And I'm not saying it's one for one, but just using round numbers. So you can still keep the market balanced. It's just they're going to get more money because product is going to trade at a better margin and better value than the crude or the cheapest form of the molecule. And that's going to be the balancing act, which is why we've talked so much over the years about new refining capacity and where that's going to go, because we will get additional refining capacity shutdowns in the US, in Europe, but we're getting increases in China and Middle East. So it's just a shift. And that's why it's hard to say that it's like, oh, this is going to be detrimental, it's going to be destructive. It's like, well, you have to look at all the products. You can't just look at oil. You can't just look at refined products. You have to put the two together and understand where the balancing is and how that balancing act is going to play out. So then when you look at the U.S. exports, on a 4-week rolling average, they've come down, but again, come down. They're at 3.8 million barrels a day. And based on everything that Saudi has done, the OSPs, the production, we're going to have a lot of strength in U.S. exports going forward. And then you look at gas oil cracks in Asia. Again, you had that nice bounce. Now, we thought you were going to get a bounce and then a stronger fade to 10. Here you had a decline, and then you had that bounce back up. But you have to look at natural gas pricing or LNG pricing, where LNG prices have gone up. And you have to look at, okay, well, LNG prices are going up. Therefore, I need to charge more, and I can't accept a lower price in order to keep at these levels, at where they should be. But storage has come down a bit, which has been supportive. But the question is now, as you get more exports from China, and we'll talk about China in a minute because that's the fun piece of all of this, we expect this to move lower. Now, is it going to go straight to 10? No. There's still enough here, especially at $17 in gas oil, to keep refiners active. But this is going to be the key crack to watch, for any type of adjustment when we look at underlying flows. So then when you look at Dubai versus Brent, you're starting to see, again, some of that move down, some of that tightness when you look at pricing differentials back to, again, the Murban adjustments, the ability to move those molecules closer, which is why the UAE will be in a better position to sell volume versus others, especially when you compare it against Brent. Now, when we look at crude oil on the water, again, we're now setting new all-time highs. It's going to stay up here. It's just because of the Iranian product in the market, the Russian product in the market. You're going to see that stay elevated. You're going to see those flows remain strong. And again, that's going to remain in place. Now, when we start looking at crude oil in transit, again, seasonally adjusted, all-time highs, we're going to see that oil in transit because miles per ton have gone up. Again, movements remain the same. But the thing is, when you look at crude oil and floating storage, it's actually a bit higher than we were expecting. We were expecting things to hug 21, 22. It's actually higher than that. And that's going to be an interesting one to watch because you had China that was a massive buyer for a significant amount of time. They typically have a sizable slowdown in buying going from now until, let's call it, the end of July. And how is that going to impact some of these flows? Because we actually have a little bit of pressure on refining activity within China, which is going to put more crude and floating storage. Now, West Africa has come down. Asia floating storage, we see going up. Middle East floating storage, we see going up. So again, that's why we do see this being an underlying concern. But what does Saudi want to do? Take crude off the water, put it into storage, reduce this number. And that's going to be an interesting one to watch because can they achieve it? And in the short answer is in a month, no. Because China's going to slow. consumer slowing. So that's where now you get into the problem point of are they just going to maintain that 9 million barrels for as many months as needed to bring this down? And I don't know the answer to that, but that's going to be the interesting one to watch as we progress. And we'll get more clarity, and obviously we'll keep you up to date on it, especially as what we think is going to happen. Asian floating storage, again, staying at that 21, 22 level, but we do see that creeping up. Now, again, we're not setting 2021 levels, but we will likely stay above 21, 22, because you can see that the comps get a bit easier. You have those drawing down, and we see this staying elevated, if not at a slight upward trajectory in general. So then when you look at Chinese import quotas, so in general, we've had import quotas coming in higher. China's big crude oil import quotas may be the bright spot. Independent refiner traders get 62.28 million tons of quota. But again, the refiners, they've been turning on new refiners. So inherently, you have to have more crude imports because you're bringing on more crude refining capacity. You have to marry that with exports, because if they're increasing import quotas, but also increasing export quotas, again, they're just replacing crude on the water with product on the water. So that means that as they absorb more crude, they're taking market share from someone else and replacing it with product that can be sold in the market. China adopted the US model. Build refiners, satiate internal demand by creating your own product, export the excess. And again, that's why it's not just, oh my God, import quotas are going up, therefore prices go higher. No, it's import quotas go up, export quotas stay the same or go down, therefore prices go up. If import quotas go up, export quotas go up, what has changed? How is it miles per ton? But again, it doesn't mean that prices won't be supported. It just means that we're not going from 74 Brent to 105 Brent. It just means that there's staying power in this realm. China issued a large amount of crude import quotas in the third batch for 2023, a positive sign for an oil market facing demand. Beijing gave refiners and traders an allocation of 62.28 million tons. According to people with the knowledge, that took the total quota this year to around 194 million tons, 18% more than the equivalent 3 batches in 2022. But remember, there were virus restrictions. There were a lot of issues, especially if they were to import that amount. But they did import more than expected. And again, other things to watch. So oil is also lower this year, but in part due to a slower than expected economic recovery in China. And after the end of COVID zero, a sustained boost in consumption could underpin higher global prices. But so far, they have not done that. And that's something that we're going to talk about in a minute. And here we are. So China's supertanker crude imports, you can see, are slowing down. They're still elevated, but slowing. And seasonally speaking, just looking at the rate of change, it typically slows. It's obviously starting at a much higher level because they're taking advantage of Russian product, Iranian product, and really taking this in. But remember, they're also slow steaming because they're trying to time when all of these things are coming through. India had a lot of weather issues. Again, they had to adjust when some of these things are moving. But there's still a lot of crude impacting this or heading their way. So even though the import quotas have risen, they've already known that, because look at these levels. You're not going to buy at these rates unless you know something is coming. So yes, the import quota is a positive data point, but the physical market has been pricing that in now for some time. All the while, the congestion index, and this is what we've been talking about in general, is that the Chinese activity was going to disappoint. And I don't mean disappoint as going below 100, being worse than the previous. I was talking about being right at 2022 levels. And that's what we're seeing here. And remember, 22 had different spits and starts with COVID. But when you average it out, that's where we sit. We don't see this massive surge, this huge revenge spending. people are not in a good position on a consumer basis. People are not in a good position on a retail basis. So you're not getting this massive boost in activity. And you did get it, but as we said, you were going to get this nice bump and then a fade. And again, that's where we are. And that's, again, continues to play out. Now, an interesting thing here is like typically you get a pivot higher in independent refinery utilization rates or Shandong rates or if you want to look at it from teapot rates. We were expecting to be at 64% by now. Right now, we're at 61.9. Now, again, there's some fungibility in that number, but you get an idea that if things were so strong there, you got these import quotas, where is the product going? And that's where we get concerned about storage. And because storage there is a very gray market. What is storage? What isn't storage? Is the number real, not real? So again, there's some fluctuation in this, but this is not something that you want to see when you have these import quotas, because again, how much of that was factored in and how much product are they currently sitting on that they're going to have to dump into the market to increase runs to take advantage of those additional imports. West African crude has had a nice drop. You could see especially when you look at last year, you had a drop at a similar time, then you had a bounce. We likely won't get that bounce just because, again, those cuts are going to bite, and that's going to push people into West Africa and into other areas that clearly still have an elevated amount. But even with that, you haven't seen physical prices strengthen. They've stopped going down, but they're still lower week on week, but they just stopped going down. So they went down. So they started higher. They've gone down. Now they've found some stability following the OPEC agreement, but they haven't bounced higher. And that's going to be an important piece to watch. Now, when we look at the U.S., gasoline had a drop of exports of 31,000 barrels a day, still above the 5-year average. Distillate had a rise of 371,000 barrels a day, slightly above the 5-year. But again, we do see that fading again because you can see it bounces around and it went from 876 to 1.2. We think it's going to average again much lower much closer to that 750, 850 number. Jet, not too much change. Propane, 622,000 barrels a day over the 5-year. That's an increase of 142,000 barrels a day. Again, we're going to continue to this is going to be pedal to the metal. As much as you'll take, we will send you. And I think that's going to be a very interesting piece going forward, where crude oil exports, again, staying above that 3 million, and we expect it to be at that 3.8 million barrel a day level. Now, when we look at just the charts, you can see that gasoline is at the highs. We do expect this to come back down. Not as much, we were expecting this to stay right at and slightly below the 5-year average. Instead, you got that nice big spike. We do see this, again, coming down, but as Pad 3 tries to manage storage, because gasoline storage is building quickly in Pad 3, they're going to have to keep those exports, I think, a bit higher than I was expecting, but that will be an interesting one to watch. As distillate, as we've been saying, on average, it's going to stay below the 5-year average. Again, not falling outside that lower end of the cloud, but just staying, again, at the low end in terms of where things have been in the past. Crude oil exports, bouncing around, still remain fairly elevated. When you look at propylene, sky's the limit. They're going to, or I should say infrastructure is the limit. They're going to try to press this as much as they possibly can to the upside. Ethane exports bouncing around are still going to stay strong. Then when you start looking at Fujairah, total products came in at 19.566 million barrels a day. That's a drop of about 4.76. It was a drop across the board. Light distillate fell 1.251 million. East of Suez gasoline got a bit stronger as we got into the beginning of this week. Small pockets of demand in some of the Southeast Asian nations, and then some demand from Japan and India because they had heavy refinery turnarounds. and shutdowns because of weather. But again, that's starting to pivot. So we do see light distillates building again. It'll just be fairly balanced, but we will see some of those increases. Middle distillate fell 787,000 barrels. East of Suez gas oil market was range bound. We don't see that changing in terms of range bound because you did have some refinery turnarounds in the Asian markets, but that's starting to, again, come back up. So we do see that what we've been talking about, those builds continuing in those regions. China gas oil demand growth is expected to be there, about 330,000 barrels a day before falling 14,000 barrels a day in Q3 as industrial activity slows. Again, the industrial side is the problem. And that's when you start looking at PMIs. China's May manufacturing PMI unexpectedly plunged to a 5-month low, not unexpected to us. But again, these are problems that we continue to see that we think are gonna lead to less demand and bigger builds. Heavy resid dropped 2.719 million to 9.371. But spot trading activity at the bunkering hubs was said to be better than average, trying to take advantage of some of those price declines. But again, it's just something that is still going to be kind of that back and forth. We do see that going back above 10 million in storage. Now, when we look at time spreads continue to fall, as we've talked about, that contango versus the backwardation. In WTI, we're in contango. We do think that Brent is going to fall in contango as well, just because of VLCC pricing and some of the other underlying headwinds. When we look at flows, here you can see Norway creeping higher again. We did get some issues in terms of underlying on more on the gas side, but we'll talk more about that tomorrow. Nigeria, small increases. Angola bouncing from June to July, and then everyone else is, I should say, fairly stable. But the one thing that's going to be interesting to watch is Libya. Libya is going to be over that 1 million. But Russia is said to be at about 4.8. And again, they're going to try to be as aggressive as possible, dumping this product into the market, which is going to keep those volumes elevated in the global market. European crude had a big spike. This is just, again, when you look at seasonally speaking, you normally get a big spike this time of year. The question is going to be, do you also get the drop, or are we going to stay at that elevated level and stay there? Based on demand levels from the refiners, from storage, it's likely we stay at the higher end. Insight, when we look at gas oil inventories, you can see that there was a small build, still staying kind of right around average, not too much one way or the other. Then when you look at gasoline is still the second highest it's ever been. But look at the delta between where we were in 2020 and where the second worst was 2022, and the gap. And we're still so elevated, which again is why we're going to see a ton of gasoline, or at least that flow of gasoline remain very consistent into the U.S. markets. Fuel oil inventory, again, that back and forth. This is going to be the arbitrage of west to east. Does it open back up? And realistically, do we see refiners in Europe trying to recrack and keep things in-house and trying to reduce their underlying buying? In Singapore, as we've been saying, total stocks are going to stay very much at the average when we look at the aggregate, and that continues to be the case, so it's going to hang around there. And the reason why is because look at light distillates. Again, light distillates are the highest they've ever been. And this includes gasoline. There is a ton of gasoline in this market, and that's why, yes, the U.S. is lower, but there's a lot of product out there, and how does it get absorbed? Where does it get absorbed? Which is why we see Fujairah building again. We have more than enough product here. Some of this is weather related, but even in a normalized level, there's still a significant amount of gasoline, which is why we still see risk to Asian cracks, especially as we come out of turnaround season, because it's important to appreciate these builds are happening during turnarounds. As we come out, we don't see this improving, which is why we see more pressure. Then when you look at middle distillate, something similar, you're getting a rate of change increase. Now, this rate of change has happened at this time before, so it's not like this is seasonally this is seasonally normal to a degree. You can see it waffles back and forth and there's a lot of noise. But seasonally speaking, this isn't abnormal, especially when you look at the average. You typically see these builds. The question is going to be the rate of change. And as you get refiners coming back, you get Chinese exports coming in, you get economic activity slowing. These builds we do see going back up. And then when you look at resid, obviously we see resid kind of flatlining, if anything, continuing to trend higher. North Sea builds, floating storage going back up. Again, that's going to be a matter of how quickly does it get sold into the market, how quickly does it get absorbed into Europe. And then as you can see here, European floating storage staying right around average, which is why we see, again, things on land remaining a bit over, elevated in general. So again, that's what we have for you today. If you have any questions, please let us know. Obviously, there was a lot to cover. Hopefully, we did a good job of providing that summary. And we'd love to hear from you. Your support is always welcome. And we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.